Yeah, Nasdaq's had a furious, very fast rally off the low and is still in a downtrend. Is still very far below its 200-day. And the reason why that's important is because the market psychology in a downtrending market produces a different effect than what you had, for example, in 2017, in 2019, in 2021, in most of 2020. It's a completely different thing when you've got a market that's in a statistical downtrend, and the way that people act is really what dictates price. So that's why we talk about technicals so much. If you've been on the right side of the technicals this year, you're looking at this huge rally off the low in growth names, and it's well deserved because stocks don't go straight up or straight down. It's not normal to have a market environment where every day is the same. So everything that's happening right now is well within what we've seen historically in downtrending markets. And then the last thing I'd point to is the VIX. And did anyone forget that the surefire way to trade this year so far, 7 months and counting, has been as the VIX gradually starts to work its way down to 20 and things get really calm, that's where you want to take some stuff off or start taking less risk or implement your stops, whatever you're doing for risk management. And then as we get to 30 to 34 range, that's where, no matter what your opinion is, you got to buy something. That, if you look at a chart of the VIX year to date, that is working flawlessly. I think it's going to continue to work. So here we are back at VIX 23.5. We're back into that point where people are a little bit less wary, a little bit less nervous, and the setup is almost perfect. So now next week, you've got 4 of the 5 largest tech companies. Every one of these companies is telling us that they are doing hiring pauses or hiring freezes, or they're withdrawing offers in some cases. Like, we know what that's a prelude to. And remember the last earnings season when they reported in April. These stocks got annihilated. The earnings were good. They crushed them on guidance. That's what I'm concerned about, and that's what I will reserve judgment until we get through those earnings reports and those outlooks and those reactions. And maybe I'll change my tune, but I'm telling you right now, a lot of the negatives are not yet in the earnings themselves. They may be in the multiple contraction, but are not yet in the earnings, and that's what I think we have to be concerned about. Last thing. Jim mentioned we're only 15% into earnings season. Not by market cap. By market cap, the real earnings season starts this coming week. We ain't seen nothing yet.